Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Markets try to gain direction basis incoming data. Now we ended last year with markets forecasting a rate cut by March, and since then markets have not moved significantly. US inflation data was out yesterday, but essentially markets are in similar ranges as yesterday, including not much of change in the rate cut probabilities. Good morning, JK. What's your take on the inflation numbers? What do you think would trigger a directional move?
Yeah, good morning. Yeah, inflation was higher on an overall basis, but there are some points to consider before looking at the implications. The headline year-on-year inflation rose more than expected, and 0.3 higher than November, while month-on-month was 0.2 higher versus expected 0.1 higher. Core inflation year-on-year was expected to moderate by 0.2%, but reduced by only 0.1% and read 3.9%. Now, the details show that housing remains firm and key components, including the key component continues to post month-on-month gains, including the used car prices, etc. But what the market read to be not so influential was the fact that this inflation number is only secondary as far as the Fed is concerned. Fed looks more at the PCE core inflation number, which was last seen for November, and that came actually on the lower side. So actually, we had seen a deflationary trend in the PCE core inflation, and this is what we are likely to look forward to for the month of December. And also the fact that there are some factors which show that going forward the inflation is not going to rise as much, because even the oil prices are under pressure in general, and the observed rentals, private rentals, are seen reducing. Even the PMI surveys show, or rather the National Federation of Industries also shows that the pricing for goods are not rising as much as it was earlier. So there is an outlook for inflation which remains quite sanguine, and therefore with the Fed anyway not at all going to raise interest rate, market continues to feel that the Fed will be inclined to cut rates, and the expectations are not changed. March rate cut is still above 60% probability, and 6 rate cuts are still priced in. That's the reason why you see even the dollar not really sustaining any gains that was seen post the data. In fact, jobless claims for the week ended January 6th was also lower by 1,000 compared to the previous week, and expectation was at 210,000. More importantly, the continuing claims came in at 1.83 million versus which was a decline of 34,000 from the previous week, again below consensus expectations. So despite these, markets expectation on rate cuts continue to be the same as before, and that's the reason why you see the dollar continuing to be somewhat softer. Also, the fact that there has been an escalation in the tensions in the Middle East region has also added to buying of bonds and fall in yields. In fact, contrary to what one would normally expect after such a CPI number, the 10-year yield fell 4-5 basis points compared to the previous day, and the 2-year was down 11 basis points. So these are not the normal reaction one would expect after a CPI number that came higher than expected. It actually shows a broader view of the market or the market players that the inflation is on a decline, and the miss is not so high. So that's the reading on the inflation number. Yes, we will look at PCE core inflation due later this month, and that will be more important from Fed's perspective as well. And then, as I said, the tension in the Middle East region has risen. There was a capture of one of the cargo ships initially by Iran, and then after that, US and UK have launched airstrikes on Houthi rebel targets in Yemen, escalating the conflict. So that's the reason for the oil prices also to go up. That probably has also supported the bond market and the gold, which never went below 2020 after the higher than expected CPI number as well. Oil prices have risen more than 1% since then also. We also had the Chinese CPI number, which continues to be on the negative side, year on year minus 0.3%, although decline was much slower than last month's minus 0.5%. And the PPI also continues to be in the negative territory at minus 2.7% on a year-on-year basis. Only the month-on-month inflation has actually come into positive 0.1% versus minus 0.5%. That's about China's inflation number. So it's still a deflation in China. Now, the expectation on China rate cut is also increasing, apart from the reserve rates, which they are expected to cut in the coming days. There is also an expectation that the medium-term lending rate also might be cut by 10 basis points on the coming Monday. The Chinese trade data also showed some improvement as far as the exports are concerned, and even imports were slightly higher than last month. However, on a year-on-year basis, exports have fallen 4.6% and the imports have fallen 5.5%. So it is definitely a big slump in the activity as far as China is concerned. So policy move by China is what we are looking forward to in the coming months, and that's probably coming week rather, and that should be supportive of the Chinese stock market, which remains at multi-year lows, whereas most other markets are at historical highs. So the dollar actually remained in a range, I would say, but any significant move was seen only in the yen, which had almost touched 146 in the yesterday's trading, but came below 145 also today morning. Now, one is the geopolitical tension. The other is expectation on US rate cuts remaining unchanged. The third factor is the third day of strong rise in Japanese stocks, and good amount of foreigner demand has been seen, and that's actually increasing the demand for yen. So 146 has become a very strong resistance for the USD against the yen. So overall dollar remains somewhat on a softer side. The ongoing demand for European countries' bonds is also supporting the Euro USD. As far as GBP is concerned, today's GDP number will be very important to see the next direction on the GBP, although it will take cues from the broader dollar moves. As far as the rupee is concerned, yes, the recent trend of strengthening tendency in the rupee had continued yesterday. We almost touched 82.90, but ahead of that, we saw nationalized banks stepping in and buying. There were flows, non-FII related flows, or rather the fundraising by corporate through bond issuances were reported, and these selling were not easily absorbed by the PSU banks as they used to do earlier, and that resulted in dollars slipping through 83, but then later it bounced back, and in offshore trades after the CPI number, it has stayed around 83.05. But our medium-term outlook for the dollar rupee is still for some more softness, and this is based on the expected flows as well as our outlook on dollar index that remains on the downside. Dollar index itself is unable to sustain any move above 10250, and the next point that we are watching technically is 100.50, and if that breaks, that will give a momentum to the dollar rupee as well. On the downside, there are no significant there's actually no much negative factors in play as far as the USD INR is concerned. So look for softer dollar overall. Of course, more data to digest as we go along in the day. Have a good weekend.
Thank you, JK. And quickly summarizing, even though inflation on an overall basis, the headline numbers were higher, core inflation moderated, but not as much as what markets were expecting. Now the Fed looks more closely at the PCE numbers, which had come on the lower side in November. So that data for December would give further guidance on the rates front. We had the jobless claims for the week, which was also lower. And despite all of these, market expectations on rate cuts continue, and dollar remains a little bit softer. In fact, very interestingly, as JK mentioned, even after yesterday's CPI numbers, we had yields falling a little bit. Now, tensions in the Middle East continue, with more recently UK and US launching attacks against the Houthi rebels. So, some sort of escalation or some sort of geopolitical tensions over there continue. China is in deflation, and maybe the pace of deflation is slowing, and expectations are of further rate cuts by China on Monday. And for rupee, we have a trend of strengthening. Yesterday, even post breaking 83, rupee USD INR went as low as 82.93 before nationalized bank step in. That's it from us today. Have a very good weekend. Tune in on Monday for the latest in the financial markets.